I'd like to ask a question that comes from Ram Tarakand from Sugar Land, Texas. He says, good morning, Mr. Buffett and Mr. Munger. You have always put great emphasis on hiring and retaining managers that not only have exceptional talent, but also adhere to the higher standards of corporate ethics and behavior. Recent events surrounding Mr. Sokol's actions have demonstrated that we were not very far from a situation where someone running Berkshire Hathaway had great talent but lacked the other quality that has made Berkshire the envy of the business world. In some ways, we are relieved that these events happened when you were still at the helm. But coming back to the succession plan that you have in place, how can you ensure that there are no more Sokols in the lineup of exceptional managers that you have?
Yeah, he made an assumption there about Sokol being the next in line, which I'm not sure was warranted, but he certainly was entitled to think that he was a candidate. That is one of the reasons that I think it's a good idea if my son Howard Buffett, who would get paid nothing and have no activities in the company, be the chairman after I'm not around, because you can make a mistake in selecting a CEO. I mean, I think the odds of us making a mistake are very, very low. Certainly the candidate that I think is the leading candidate now, I would lay a lot of money on the fact that he is straight as an arrow. But mistakes can be made. The Bible says the meek shall inherit the earth. But the question is, will they stay meek? And the idea of having an independent chairman who would be voting a lot of stock, because even at my death, because of the concentration of A stock and so on, the executors would have a very significant block of stock. And if some mistake were made, it would be easier to change if not only a very large block of stock were available to express an opinion, but also if the chairmanship was not locked in with the CEO. It's gotten less tough to change CEOs at companies where either their moral or their intellectual qualities are found lacking. But it's still difficult. It's particularly difficult if they turn out to be a mediocre CEO. If the person's really bad, people will rise up sometimes, and particularly if they have meetings without the CEO present. But it's not an easy job to displace a sitting CEO who also holds the chairman's position and controls the agenda and all of that. So I think an independent chairman, particularly one that represents a very large block of stock and has no designs himself on taking over the place, is a safety measure for the possibility, however remote, that the wrong decision is made. But I will tell you that the directors of Berkshire will be thinking every bit as much about the quality of the person as a human being as they will be thinking about their managerial skills, because it's vital that you have somebody at Berkshire, in my view, that is running the place that really cares more about Berkshire than he does about himself in terms of advancement. And I think we have multiple candidates that fulfill that, and the idea of an independent chairmanship is part of the belt and suspenders. Charlie?
Well, your idea about the Buffett family has a precedent. The Rockefellers left the management of Standard Oil many, many decades ago, but they did intervene once, and that was to throw out, what was it, the head of Standard of Indiana, and it was on moral grounds. So that sort of thing can happen, and you have put another string in our bow.
This is Sean Shaochu from Ottawa, Ontario. Warren, Charlie, I admire you guys tremendously. I want to ask a question about the valuation of your company. You said price is what you pay and value is what you get. In your letter to the shareholders this year, each Class A share owns about investment about $95,000, and each share commands an earning of $6,000. So in my simplistic way of calculation, each share is worth $95,000 of investment plus the earnings discounted at 7%. That's another about $90,000. So it adds up to about $185,000. Is that correct? Does that mean the complexity of your empire is a value trap?
We give those figures because we think they're important, both the investments per share and the operating earnings per share, excluding the earnings that come from the investments, and leaving out insurance underwriting profits or losses because we think at worst they'll break even, but they do bounce around from year to year. Those figures are pre-tax on the operating earnings, so I'm not sure whether you're applying your discount factor to pre-tax or after-tax, but we think they're important. And I would expect, well, the operating earnings, are almost certain to increase. How much, who knows? But that number is likely to go up. The investments are still about the same as at year end, but they could go up or down based on whether we're able to buy more operating businesses. Our goal is to build both numbers to some extent, but our primary goal is to build the operating earnings figures. If Charlie and I had to stick a number in an envelope right now in front of us as to what we thought the intrinsic value of Berkshire was, well, neither one of us would stick a figure. We'd stick a range because it would be ridiculous to come up with a single specific number, which encompasses not only the businesses we own, but what we're going to do with the capital in the future. But even our ranges would differ modestly. And they might differ tomorrow in terms of how I would feel versus today, but not dramatically at all. I would say this. I think I certainly, you've received signals once or twice. When we said we would buy in our stock, we obviously thought that it was selling below the bottom of a conservative range of intrinsic value, and we did that once some years ago, and by saying so, of course, the stock went up, and so we never got any stock bought. And so there's sort of a self-defeating factor about taking the kind of approach to it that we do in terms of really telling people that the only reason we'll buy in stock is because we think it's cheap. That is not standard practice in corporate America at all. In fact, corporate America to some extent buys in their stock more aggressively when it's high than when it's low, but they may have some equation in their mind that escapes my reasoning power. But we do not regard Berkshire as overpriced, and I would say that we had very recently, we had a very, very large international company that might well have been interested in doing something with Berkshire, and it's a very nice company, but it's bigger than we can handle unless we would use a lot of stock, and we won't use the stock. We just think our shareholders would come out behind, be a wonderful company, and make a lot of headlines, but in the end, our shareholders would be poor because our stock is a currency, and unless it's fully valued, it's a big mistake to use it as a currency. Now, we used some in the Burlington deal, but we used a whole lot more cash, and in effect, we only used 30% for stock, and it was worth doing. but it was painful. And if Lubrizol wanted to do a deal involving stock, we would not have done it. I told James Hambrick that right off the bat. So we had absolutely no interest in buying Lubrizol. We were perfectly willing to give close to $9 billion in cash. And in my view, we were getting our money's worth. But we would not have given a significant portion of it in Berkshire stock because we would be giving away part of the businesses that we already own. And we like Burlington, and we like See's Candy, and we like Iscar. And to give away a portion of those, even to get another very good business, would not make financial sense for our shareholders. So you can draw your own deductions about our calculations of intrinsic value from that statement. Charlie?
Well, he's obviously looking at the two right factors. And I think that we have not permanently lost the ability to do some interesting things eventually with our enormous wealth in cash and marketable securities. We won't always be as inactive as we are now.
Well, we're not that inactive, Charlie.
Well, I don't know. You practically crawl out of your skin sometimes.
$9 billion is, if we say normal earning power is $12 billion, that uses up a good portion of 1 year's quota. Although we'd like to use more. I mean, there's no question.
Now you're talking.
Can you see us using stock in the next few years?
If the business were good enough, of course. Yeah. Our trouble is, it's a terrible trouble you people have. And the businesses you already own are so good, it's not wise to part with them to get a business we don't own.
This is Warren, and Charlie too, from your longtime Omaha friend Dick Holland. Whenever you talk in a general way about America's economic future, your remarks are invariably positive, even glowing, despite the severe problems of growing public and private debt, the huge budget imbalances that result, and no real policies to solve these problems. Some experts believe that we may reach the point where future bond offerings to cover the rising debt might fail. Many wonder if we are not entering a time of national decline. How can a lousy, long-term U.S. economy make you so happy? And why do you see gold nuggets where others see salt?
That's from Charlie's good friend as well, Dick Holland, who we both have known for 60-plus years. I don't see how anybody can be other than enthused about this country. If you look back to 1776 or 1789, whichever one you want to date it from, it has been the most extraordinary economic period in the history of the world. In fact, if you go back, I was born on August 30th, 1930. Now, if somebody had come to me in the womb and said, let me tell you what it's like outside now. The stock market has just crashed, but you haven't seen anything yet. 4,000 banks are going to fail. The Dow Jones average is going to go down to 42. It was 381 back just a little bit before you were conceived. And it's going to go to 42. They're going to close the banks for a while. We're going to have 25% unemployment. We're going to have the Dust Bowl in the Midwest. The grasshoppers are going to take over. It would be like in that Woody Allen movie where he says, go back, go back. All that's happened since August 30th, 1930 is that the standard of living of the average American has increased 6 for 1. 6 for 1. That's absolutely incredible. I mean, if you look at centuries where nothing happened for the average person, I mean, century after century. So we have a system that works magnificently. It gets gummed up periodically, and it always has troubles. I mean, my father was very anti-New Deal. So my sisters and I sat around a dinner table from the first we can remember hearing how things were going to go to hell. As a matter of fact, my father-in-law told my wife-to-be and her mother that he wanted to have a talk with me before we got married. And he was very much on my side, so I was not in a panic about this or anything. But I went down to his house shortly before the marriage, and this wonderful man, Doc Thompson, sat in a chair for a couple of hours. And he said, Warren, he said, I just want to tell you that you're going to fail, but it's not your fault. And he said, you and Susie, my daughter, you know, if you starve, she would have starved anyway. I mean, it is not your fault. It's because, you know, it's because the Democrats are in, you know, and they're going to take the country down the road to communism, and, you know, and just don't worry about the fact you're going to fail. And this went on for quite a while. And then he blessed me and we got married. It was a happy ending. But ever since, when I got out of school in 1951, the two people I admired the most in the world, my dad and Ben Graham, both said, you know, you've got a good future, but don't start in stocks now, because there's never been a year when the Dow Jones average has not ended up below 200, and it's above 200 now. It's much too high, and if you start now selling stocks to people, they're going to have bad experiences. And so why don't you go wait a while and go work in the Omaha National Bank or do something, park yourself on the sidelines. There's always negatives. The country always faces problems. I mean, this country went through, you know, it went through a civil war. You know, it's gone through all kinds of things. But what happens? You know, we have a few lousy years from time to time. I mean, we've had probably 15 recessions since the country started. And we will always have a list of 10 or 15 things at the start of the year that will tell you why, you know, this country can't possibly work well. But all I can tell you is that it doesn't do it in a straight line. But the power of capitalism is incredible. I mean, you know, that's what is bringing us out of this recession. I mean, monetary and fiscal policy have some utility, and certainly in the fall of 2008, the government was needed in a huge, huge way. It was the only one that could do what was needed. But if you look at the history of the United States, you know, probably half of our recessions have occurred during, we'll say, in the 19th century, when people didn't even know what fiscal or monetary policy was. I mean, what happened was that excesses would come in, and then the resuscitative power of capitalism would set the country back on the right, on a stronger growth pattern. And that's happened time after time after time. And the game isn't over. I mean, it is not like the potential of America has been used. What has happened is the rest of the world has caught on to some extent. So you're seeing, you know, some state capitalism in places like China, and they're turning economies loose that have been dormant for centuries. But it's not because the people are smarter. It's not because they work harder. It's just because they have tapped into a system that works marvelously over time. And I will tell you, in the next 100 years, you're going to have probably 15, maybe as many as 20 lousy years, but we will be so far ahead of where we are now that, you know, that will be unrecognizable. Charlie?
Well, I think you can go back a lot farther than that. You know, Europe survived the Black Death, where about a third of the people died. The world is going to go on.
That's wildly optimistic for Charlie. Have you got anything more encouraging than that to say, Charlie?
Well, I don't know. I understand a little bit of Dick Holland's point of view. And by the way, I've known him a long time. He aced me out of any hope of being the chief candle snuffer at the Unitarian Church. He was so damn good at it. Anyway, What was the
Can
question?
you bring yourself to say anything optimistic?
Angie Jansen of Cambridge, Massachusetts. My question is, aside from the need to put huge amounts of capital to work, do you still believe that a high return on tangible capital business like Seas or Coke is the best asset to hold in an inflationary environment? Or do you now think an irreplaceable hard asset with pricing power like a railroad or a hydroelectric dam is superior?
Yeah. The first group is superior. Just I mean, if you can have a wonderful consumer product, it doesn't have to be a consumer product, a product that requires very little capital to grow and to do more dollar volume, as will happen with inflation, even if you don't have unit growth. And it doesn't take much capital to support that growth. That is a wonderful asset to have in inflation. I mean, the ultimate test of that is your own earning ability. I mean, if you're an outstanding doctor, lawyer, whatever it may be, teacher, as inflation goes along, your services will command more and more in dollar terms, and you don't have to make any additional investment in yourself. People think of that, with a very long-lived real estate asset or something of the sort, or a farm or anything where additional capital is not required to finance inflationary growth. The worst kind of businesses are the businesses with tons of receivables and inventories and all of that. And in dollar terms, if their volume stays flat but the price level doubles and they need to come up with double the amount of money to do that same volume of business, that can be a very bad asset. Now, normally, we are not enthused about businesses that require heavy capital investment, just like utilities and the railroad. We think that, on the other hand, that particularly with the railroad, that where you do not have any guaranteed lower rate of return, that you should be entitled to earn returns on assets that are becoming more and more valuable to the economy, as whether it's because of inflationary factors or because of just natural growth factors, or in the case of the United States, I think it'll be both. But the ideal business, See's Candy is doing, it was doing $25 million of volume when we bought it. And it sold 16 million pounds of candy at a little more than it retails $1.90, and we had some quantity discount. So we were doing close to $30 million worth of business. Now we're doing well over $300 million worth of business. It took $9 million of tangible assets to run it when it was doing 30, and it takes about 40 million of tangible assets at 300 and something. So we've only had to plow back $30 million into a business which will make us, well, it's made us probably $1.5 billion pre-tax during that period. And if the price of candy doubles, we don't have any receivables to speak of. Our inventory turns fast. We don't store it or anything like that. We gear up seasonally, and the fixed assets aren't big. So that is a much better business to own than a utility business if you're going to have a lot of inflation. Charlie?
Yeah, and what's interesting about it is that we didn't always know this. And
sometimes we forget it.
That's true too. But it shows how continuous learning is absolutely required to have any significant achievement at all in the world.
Yeah, and it does show, I've said in the past that I'm a better businessman because I'm an investor, and I'm a better investor because I'm a businessman. There's nothing like actually experiencing the necessity, particularly in the 1970s when inflation was gathering strength in the early 80s. You would see this absolutely required capital investment on a very big scale that really wasn't producing anything commensurate in the way of earnings. I wrote an article for Fortune called How Inflation Swindles the Equity Investor back in 1977. You really want the ideal asset, is a royalty on somebody else's sales during inflation, where all you do is get a royalty check every month, and it's based on their sales volume, and you made you came up with some product originally, licensed it to them, and you never have another bit of capital investment. You have no receivables, you have no inventory, you have no fixed assets. That kind of a business is real inflation protection, assuming the product maintains its viability. So even though we are going into some very capital-intensive businesses, part of that reflects the fact we can't deploy the amount of capital we have in a whole bunch of seized candies. We can't find them. We'd love to find them, but we can't find them in the quantity. So we are not doing as well with capital when we have to invest many billions a year as we would if we were investing a few millions a year. There's no question. That's true in investments. It's true in operating businesses. There is a real disadvantage to size, and we just hope that problem grows.
Now you're talking.
This question comes from Neil Steinhoff, who writes, the commodity market, and particularly gold, have appreciated astronomically over the last few years. My Berkshire Hathaway stock is only slightly better or doing better than it was in 2006. It's barely kept up with inflation, he says. Please explain why you have not invested more heavily in commodities. As long as Ben Bernanke continues to print money, and there's no indication that he's going to stop anytime soon, isn't it right that commodities, and particularly gold, will continue to appreciate?
Well, I would point out that when we started with Berkshire, it was about 3/4 of an ounce of gold, and gold was $20 an ounce then, and it was 15. So gold, even at 1,500, has a ways to go. And I think he's right about inflation, but if you think about it, there are three major categories of investment, and you ought to think very hard about which category you want to be in before you start thinking about the choices available within that category. Now, the first category is anything denominated in a currency. It can be bonds, it can be deposits in a bank, it can be a money market fund, it can be cash in your pocket. And if you will reach in your pocket, I don't like to do this, but and pull out your wallet. You're watching an historic event. If you look at this, and I might point out this is a 1. Charlie carries on the back of it, it says, "In God we trust." And that's really false advertising. If Elizabeth Warren were here, she would say, quite properly, it should say, "In government we trust." Because God isn't going to do anything about that dollar bill, if government does the wrong things. In terms of keeping it as valuable as it was when you parted with it to buy a bond or put it in a bank. Any currency-related investment is a bet on how government now and in the future will behave. And if you happen to be fortunate to live in Zimbabwe and you decided to make currency-related investments, your family would have left you by now, and it was not a good decision. Almost all currencies have declined in value over time. I mean, it may be built into almost any economic system that it will be easier to work with a currency that declines in value than a currency that appreciates in value. And the Japanese might reaffirm that here with their experience. So as a class, currency-related investments, whether they're in the UK or the United States or any place else, unless we're getting paid extremely well for having them, we do not think make much sense. The second category of investments regard items that you buy that don't produce anything, but that you hope someone will pay you more for later on. And the classic case of that is gold. And I've used this illustration before, but if you take all of the gold in the world, don't get too excited now, and put it into a cube, it will be a cube that's about 67 feet on a side. That'd be 165,000 or 170,000 metric tons. So you could have a cube, if you owned all the gold in the world, you could have a cube that would be 67 or 68 feet on a side. And you could get a ladder and you could climb up on top of it and you could say, I'm sitting on top of the world and think you're king of the world. You could fondle it, you could polish it, you could do all these things with it, stare at it. But it isn't going to do anything. All you are doing when you buy that is that you're hoping that somebody else a year from now or 5 years from now will pay you more to own something that, again, can't do anything. The person then thinks that somebody else will buy something 5 years later from him. In other words, you're betting on not just how scared people are now of paper money, you're betting on how much they think a year from now people will be scared 2 years from then on. Keynes described all of this, I think it was in chapter 12 of the General Theory when he talked about this famous beauty contest where the game was not to pick out the most beautiful woman among the group, but the one that other people would think was the most beautiful woman. And then he carried it on to second and third degrees of reasoning. Anytime you buy an asset that can't do anything, produce anything, you're simply betting on whether somebody else will pay more for, again, an asset that can't do anything. And actually, we did that with silver, but silver had an industrial use. And about 13 years ago, I bought a whole lot of silver. And if you'll notice, silver's moved recently. So my timing was only about 13 years off, but who's perfect? The third category of asset is something that you value based on its what it will produce, what it will deliver. You buy a farm because you expect a certain amount of corn or soybeans or cotton or whatever it may be to come your way every year. And you decide how much you pay based on how much you think the asset itself will deliver over time. And those are the assets that appeal to me and Charlie. Now, there's some logical follow-on to that. If you buy that farm and you really think about how many bushels of corn, how many bushels of soybeans will it produce, how much do I have to pay the tenant farmer, how much do I have to pay in taxes and so on, you can make a rational calculation. And the success of that investment will be determined in your own mind by whether it meets your expectations as to what it delivers. Logically, you should not care whether you get a quote on that farm a day later or a week later or a month later or a year later. We feel the same way about businesses. When we buy ISCAR or we buy Lubrizol or whatever, we don't run around getting a quote on it every week and say, is it up or down or anything like that. We look to the business. We feel the same way about securities. When we buy a marketable security, we don't care if the stock exchange closes for a few years. So when we look at Berkshire, we are looking at what we think can be delivered from the productive assets that we own and how we can utilize that capital in acquiring more productive assets. And there will be times, cotton doubled in price, much to our chagrin at Fruit of the Loom, but if you own cotton for the right 6 or 8 months in the past year, you came close to doubling your money. But if you go back a century and try to make money owning cotton over time, it has not been a very good investment. So to pick a product, crude oil, cotton, gold, silver, anything that, and of course cotton has utility. Gold really doesn't have utility. I would bet on good producing businesses to outperform something that doesn't do anything over any period of time. But there's no question that rising prices create their own excitement. So when people see gold go up a lot, I mean, if your neighbor owns some gold and you think you're smarter than he is and you didn't own any, and your wife says to you, how come that jerk next door is making money, and you're just sitting here, it can start affecting behavior. And people like to get in on things that have been rising in price and all of that. But over time, that has not been the way to get rich. Charlie?
Well, I certainly agree with that. And besides, it's something peculiar to buy an asset which only will really go up if the world really goes to hell. It doesn't strike me as a terribly rational thing to do. I think you ever figure on leaving the country because the country is going to kill you. And if you assume all the other countries you might go to will also be thoroughly screwed up, I think all those people should buy a little gold. But I think the rest of us would be better off with Berkshire Hathaway stock. And of course, there's another class of people that think they can protect themselves by buying paintings of soup cans. I don't recommend that either.
One thing about gold also is that in addition to this 67-foot cube, more gold is being produced every year. So you have to have buyers not only to offset sellers in the natural course of events, but you have to absorb something like $100 billion worth of added items of no utility. I mean, it's really interesting. I mean, they dig it up out of the ground in South Africa and they ship it to the Federal Reserve in New York and they put it back in the ground. I mean, if you were watching this from Mars, you might think it was a little peculiar, but think of how many people it makes happy. I might mention that the value of that cube, all the gold in the world, is now about valued at 1,500 plus, is about $8 trillion. And there are 1 billion acres roughly of farmland in the United States. That's a little over 1.5 million square miles. And that's valued at something over 2 trillion. And if you take 10 Exxon Mobils, you get up maybe another 4 trillion. And maybe not that much even. And so you could own all of the farmland in the United States, every bit of it. And you could own 10 Exxon Mobils and you could stick $1 trillion or so in your pocket for walking around money. And you could have your choice of that or this 67-foot piece of gold that you could fondle. And that may seem like a close choice to some people, but not to me.
Well, you would also need an army to defend the gold. And it's really not a very good spot.
Okay, number 6.
Yeah.
Mr. Buffett, Mr. Munger, when you were raising your first investment funds, how did you go about attracting investors? And once you had your first funds and your first investors, how did you go about growing them?
Sounds to me like a man that's about ready to start a hedge fund. In my case, I'd moved back here from New York in March or so of 1956, and a few members of my family said we'd like you to manage our investments just like I did when I was selling securities out here before I went to New York. And I didn't like being in the security selling business, partly because if I sold somebody a stock at 20 and it went down to 10, I wanted to buy more, but I couldn't face the idea of people that had bought it at 20 and based only on confidence in me, not because they understood it, and now they were feeling depressed. And it just wasn't very satisfactory. I could not do as well managing money if people were watching every decision as I could if I did it in a room all by myself. So I just told these 7 members of the family, one of them, actually, it was my roommate in college and his mother, they came in also. I said, if you'd like to join up in a partnership, I'm not going to tell you what's going on, But I will tell you that I will be doing with my own money what I'm doing with yours. Later on, I put all my own money in. And it just was very slow. A few months later, Graham Newman that I'd worked for was liquidating, and a fellow named Homer Dodge asked Ben Graham what he should do with the money he was getting out of Graham Newman. He said, this kid used to work for me and he's okay. And so he came out and went in with me, and another fellow late in the fall had seen the notice of partnership formed in some legal paper, and he said, what's this? And came in with me. And we just stumbled along. And for almost 6 years, I operated out of my house, no employee. I kept all the books. I filed the tax returns. I went out and picked up the stocks personally and stuck them in a safe deposit box. When Charlie came along, I kept chiding him about the fact I met him in 1959, and I said, law is okay as a hobby, but it's no place for a man with your intellect to spend his time. Well, I'll let Charlie take it over from there.
It actually took me a long time to leave what it was a family business. And so any of you who are having a slow time accepting good ideas, why, should be cheered by my example, because it was some years after you started working on me, and you pounded on me, and I slowly got the point.
And he was asking about attracting money.
Well, of course, it helps if you conducted yourself in life so that other people trust you. And then it helps even more.
Is he explaining why I was so slow and he was so fast?
Then it helps even more if other people are right to trust you. So the formula is quite simple. We're first one, then the other.
Unfortunately, with the present fee structure, just attracting money rather than performing with it can be enormously lucrative. So the skill of attracting money may be, at least in the short run, and maybe the intermediate run, it may be a more important quality than the ability to manage money. But neither one of us ever charged any fixed fee of any kind. Am I right on that, Charlie?
Well, we stopped taking any significant overrides on other people's money at very young ages and at very small amounts of net worth. I wish our example were more common, but I like our compensation practices too, and they're spreading slowly.
Good morning, Warren and Charlie. John Norwood from West Des Moines, Iowa. I have a question on legacy. 100 years from now, Warren and Charlie, what would each of you like to be remembered for?
Old age.
Yeah, I've heard Warren say that what he once said at his funeral is, that's the oldest looking corpse I ever saw. I have a different saying that came down from one of my great-grandfathers, and I think he wanted to be remembered for a fortune fairly won and wisely used. That's a pretty good system.
Yeah, I would, if you really ask me, I'd probably like teacher. I enjoy teaching a lot. And some people think I do a little too much of the didactic stuff, but I like students coming, and I benefited by some fabulous teachers, starting with my dad, but going on to Ben Graham, going on to Tom Murphy. I mean, there are lots of great teachers. So I would say that. I might point out that on Wilt Chamberlain's gravestone, I think it says, "At last I sleep alone." Which,
Yeah.
well, we have some people from Kansas here anyway. Okay, Becky.
Good morning, Mr. Munger and Mr. Buffett. This is Mary Bundrick from Rochester, Minnesota. I was wondering, what factors would you consider in deciding between investment in Berkshire Hathaway versus a no-load mutual fund?
Well, I advise people to buy index funds, actually, if they're not going to be active in investments. I mean, if you just are going, if you've got a day job and you want to just put money aside over time, I think the average individual will do better buying an index fund consistently over time than almost anything else available to them. I think it'll be a perfectly satisfactory investment. It'll never be regarded as a great investment, but it'll be a perfectly satisfactory investment. If I personally had a choice between an index fund or Berkshire at present prices, I would rather own Berkshire. But I wouldn't be unhappy if you told me I had to leave all my money in an index fund for the rest of my life. But I like Berkshire better. Charlie?
Well, I like it a lot better, and I'd be very unhappy if I had to own an index fund. My ambitions are larger. I don't think the average return of a skilled investor over the next 50 years is going to be as good after all factors as it was over the last 50 years. So I think reduced expectations are the best defense any investor has. And after that, I think Berkshire's a pretty good bet.
Charlie's big on lowering expectations.
Absolutely. That's the way I got married. My wife lowered her expectations.
And he lived up to them.
Warren and Charlie, both of you expressed a very positive view of BYD and its chairman, Wang Changfu, when Mid-American bought its stake in 2008. Does BYD remain as attractive a long-term investment now as it was when you acquired your stake? If so, why? Has BYD's recent pattern of unexplained product launch delays affected your confidence in the operation?
Charlie's the BYD expert, so I'm going to let him start on that one.
Well, of course, the price is still way higher than the price Berkshire paid, and so almost by definition, it's not quite as cheap as it was then. Any company that tries to move as fast as BYD does, and on as many fronts, is going to have various delays and glitches. But I would say I'm quite encouraged by what's going on, and I expect delays and glitches. They got in trouble in the auto distribution, but they tried to double auto sales every year for 6 years, and it worked the first 5 times. Yeah.
I have nothing to add.
Hi, Warren and Charlie. My name is Catherine Borud. I'm from Los Angeles, California. I invest primarily in commodities and commodity equities. I started out back in 2007 buying oil. In the summer of 2008, we reached the peak of the oil bubble. And that's when I reversed my holdings and started shorting oil. I made a nice profit. In 2009, I started buying oil again and oil equities. And I've been doing pretty well. But given the status of the world today and the price of oil, I'm questioning my investments. Is this another oil bubble? Has oil reached its peak? Should I keep my holdings? Should I short oil? Should I exit oil altogether and move into other commodities or other investments? So my question to you is, what are your sentiments regarding oil?
Well, I would say you've done a whole lot better than we have. So I think the crowd would rather hear from you. We actually did take a position in oil, I don't know how many years ago.
A long time ago.
Long time ago.
It was $10 a barrel.
And it wasn't that long ago, though, incidentally.
No,
I mean, that was in the 1990s. Although we we've seen oil a lot cheaper than that. And East Texas oil sold for $0.10 a barrel in 1932. We really don't know. I mean, obviously, you're dealing with a finite resource. I don't know whether the world's up to 88 million barrels or was down around 85 million barrels, but there's got to be some comeback. So I wouldn't be surprised if the current figure's getting pretty close to 88 million barrels a day. That's a lot of oil to take out of the ground every day. And of course, there are new frontiers have been found, but you've stuck a lot of straws into the earth, and it is a finite number. So the one thing I can almost promise you, is that oil will sell for a lot more someday. Interestingly enough, how many producing oil wells do you think there are in the United States? Well, the answer is something like 500,000. Now, there's these stripper wells. There's wells out near Charlie that have been going for 100 years.
Yeah.
But we have looked in a lot of places now. And what's happening, of course, from the standpoint of the United States companies, is that the smaller countries where oil is being found now are quite a bit smarter about how they grant their concessions than people were 50 or 75 or 100 years ago, so that they drive much more intelligent deals than was originally the case when we went exploring around the world. But I have no idea. We traditionally, BNSF had hedged a certain amount of oil, and because they obviously use huge quantities of diesel, and I suggested to them, although how they run the BNSF is up to them, but I really didn't think we could guess the price of oil. And I thought if we could guess the price of oil, we didn't need to run the railroad. I mean, it took a lot of effort, time to run that railroad. And if we knew how to make money just sitting in a room trading oil, why not do that instead? So we don't hedge. Well, in terms of Berkshire's parent company policies, we don't hedge anything in the way of commodities. Some of our subsidiaries do, and that's fine. They're responsible for their businesses. But there are very, very few commodities that I've ever thought I would know the direction of their movement in the next 6 months or a year. The one thing I'm quite convinced of, as we talked about this morning, is the fact that the dollar will become less valuable over time, so that the dollar price of most things will go up, and maybe go up very substantially. Whether they go up enough so that you have the same amount of purchasing power after you pay tax on your nominal gains is another question. I really think that an intelligent person can make more money over time thinking about productive assets, rather than speculating in commodities or when, for that matter, fixed dollar investments. But that's maybe my own bias. Charlie?
Well, if we'd done nothing but oil from the very beginning, I am confident that we would not have done nearly as well as we have. To me, that's perfectly obvious. So I think what we've done is much easier than what you're trying to do.
And we like easy.
Yeah, we're not trying to make it any more difficult than we have to.
I really don't know any way to have an edge in that sort of activity. I mean, if you are going to try and figure out when to be long or short oil or natural gas or copper or cotton or whatever, I don't know of people who I feel would have an edge in trying to do that over the next 10 years, but I do know people where I think they'd have a very significant edge in investing in common stocks, and maybe distressed bonds for that matter too.
Yeah, trading oil worked best of all for the people who bribed Nigeria. That's not our milieu.
Well, that's an insight I hadn't heard before.
Hi, I'm Whitney Tilson, a shareholder from New York. Thank you for including in your latest annual letter such complete and clear valuation information regarding Berkshire. You stated that the operating earnings of the insurance businesses are excluded from your earnings table. And I know you said this morning that 2011 is going to be a break-even year at best, but in light of the disclosure in the annual report that Berkshire earned $17 billion in profit over the last 8 years without a single money-losing year, are you being overly conservative? Don't you think the intrinsic value of your insurance businesses is more than just their float, especially GEICO, for the reasons you discussed this morning?
Yeah, I'd agree with that, Whitney. But it's very hard to estimate, what the normal underwriting profit might be over the next 20 years or something of the sort. And so I agree with you. I don't know whether I'd call it overly conservative. I would say it's conservative to assume break-even underwriting. But as you will, I mean, if we had another Katrina or something of the sort, and forget about winter storms in Europe and all that, I mean, we could lose significant money in underwriting this year, and we expect to lose significant money in underwriting, maybe every 5th year, every 10th year, whatever it might be. But I think you're right in saying that it would not be inappropriate to include some normalized underwriting profit in addition to the calculation that I made in the annual report.
Whitney, let me help you by asking another question of Warren. Is there any other large casualty insurance operation in the world that you know of that you would trade for ours?
Well, not remote. No, nothing close. I mean, however we lucked into it, we have an unbelievable insurance operation, and I mean, GEICO, is fabulous, and if you think about since 1936, the idea has been out there, but with all the strength that all the other companies had and the agency plants and everything else, GEICO has now moved to where it's the third largest in the United States and gaining ground every day on the two ahead of them and doing it very profitably. GEICO's combined ratio, GEICO had an underwriting profit of close to 8 points, as I remembered in the first quarter. Now that's going to be probably the best quarter of the year, I should add, but it's a marvelous business. Ajit has built a business from scratch in the reinsurance business that in many respects, he operates all alone. He may not see a lot of transactions in any given period of time, but there are certain things where if somebody wants huge amounts of insurance and a quick answer, or even a slow answer sometimes, we'll give them a quick one, there's really nobody else to call. It's a little like Charlie mentioned on acquisition opportunities. So he's done it. I mean, it didn't exist when he got there. Tad Montross has got a magnificent operation at Gen Re. I mean, it had to get shaken out to quite a degree, but Tad has got a very, very disciplined business there. And then we have a group of smaller companies that some of them have some very unusual franchises. So they're really, I didn't have anything to do with it, so I can brag about these people, but they have really done a job in building an insurance company that I don't think there's anything like it.
Yeah. Some of you people that have been around a long time, you invested with an Omaha boy, and you ended up owning part of the best in casualty insurance business in the world.
Yeah, if you go to 30th and Harney, you'll see a building there of National Indemnities. We paid $7 million for National Indemnity, $1.4 million for its sister company, National Fire and Marine, and that's the same building that we operated out of in 1967. We're operating out of it today. The only difference is that today it's got more net worth than any insurance company in the world.
Yeah, so it's not that great a business as a business, casualty insurance. It's a tough game. There are temptations to be stupid in it. It's like banking. But if you're in it, I think we've got the best one.
Okay, with those modest statements, we'll move on to Becky.
This question comes from Mark Jordan in Charleston, South Carolina. He writes, in a period of high inflation, which particular businesses owned by Berkshire Hathaway will perform the best, and which will perform the worst, and why?
Well, the businesses that will perform the best are the ones that require little capital investment to facilitate inflationary growth and that have strong positions that allow them to increase prices with inflation. And we have a candy business, for example, and the value of the dollar since we bought that candy business has probably fallen at least 85%, I would say, 80 to 85%. And that candy business sells 75% more pounds of candy than it did when we bought it, but it has 10 times the revenues, and it doesn't take a lot more capital. So that kind of a business, any business that has enough freedom to price to offset inflation and doesn't require commensurate investment or huge investment to support it, will do well. Businesses like our utilities, which get, in effect, a bond-like return, but require, if you're going to build a generating plant, it costs twice as much per kilowatt hour of capacity, and all you're going to get is a fixed return, and yields on bonds go up, perhaps dramatically if you get high inflation, is not going to do that well in an inflationary period, just because it has certain aspects of a bond-like investment, and bonds generally are not going to do well in inflation. Charlie?
Well, but like our insurance operations, our capital-intensive railroad business is certainly one of the best railroads in the world, and our utility operations are certainly one of the best utility operations in the world. And so it isn't all bad to be up there world class in your main businesses.
Our railroad, the government's talked about building a high-speed rail system in California. I think they're talking about 800 miles of track. And their estimated cost was about $43 billion. And estimated costs on constructions of things like that go up dramatically, much more often than they get reduced even by a minor amount. And of course we paid $43 billion, counting debt assumed, for a rail system which has 22,000 miles of main track and 6,000 plus locomotives and 13,000 bridges if you ever want to buy a bridge. So that the replacement value of that asset during inflationary already is huge, and it would grow dramatically, and the world, our country, will always need rail transportation. So it is a terrific asset to own. I'll just leave it at that.
This question comes from Matthew Palmer of North Andover, Massachusetts, and he writes, Mr. Buffett, you have praised Ajit as a possible successor. Since he may be in line as our next CEO, can you give us a concrete example of a policy that he's written that's impressed you? And can you talk a little bit about the way he thinks, since we rarely get an opportunity to hear from him?
Yeah, Ajit is not exactly a publicity hound. Ajit, no. I can't think of any decision he's ever made that I think I could have made better. And I'm not privy to all of his transactions anymore. There are lots of them that are not of huge size or of great interest. But he tells me about all the interesting things that come along and all the very big things that come along. And I would say this: you'd be better off voting with him than with me after listening to any proposition he brings up. He is as rational a thinker as Charlie is, as anybody I've met. He loves what he does. He's creative. He's very creative. We have moved into one area after another in reinsurance. When people came in copying us in one area of business that we would be operating in, Ajit comes up with something else. Lately, we've been much more active in life reinsurance. But who knows what tomorrow brings? I mean, if there happens to be a huge cat in the third quarter of this year or something of the sort, that might open up all kinds of opportunities in writing covers if capacity got strained. But who knows what will happen? All I know is that Ajit's mind works like a machine, day after day, and he does love what he does, which is an important part of doing well in any activity. And I don't know what his best deal was. I know what my best deal was, which was hiring him. Charlie?
Yeah. Sir William Osler, who created a model medical school for the world, used to say that the secret of success in a field was getting very interested in it. Well, Ajit is really interested in what he does. Many of you don't know this, but every Thanksgiving, Ajit flies to London because they don't have a Thanksgiving holiday.
We give him Christmas off, though. Ajit, we just, he is. I say how invaluable he is, and I'm not exaggerating when we talk about him. And he is, to an extraordinary degree, he thinks of Berkshire first. Ajit, at various periods when insurance companies became popular for one reason or another, there was the big thing about Bermuda companies some years ago. Ajit could have monetized himself to an incredible degree. He still could do it. I mean, people would hand him a significant percentage of any company being formed with lots of money, so that immediately he could create, I would guess, in the hundreds of millions of wealth without lifting a finger, just by somebody putting up, a couple $1 billion and saying you've got 20% of it or whatever it may be. And I mean, and listen, he's smart. He knows that, and it doesn't cross his mind to do anything like that. I mean, we have in comp. He always thanks me for what I do at the end of the year, and I feel I've left off a zero. When I get all through, he's just a remarkable human being, and we are very, very lucky that I think he has a lot of fun in what he does at Berkshire. He's got a cadre of about 30 people that work with him. There's many more that are settling claims and doing that sort of thing on runoff business, but you won't find anything like it, in my view, not only in the insurance world, but really in almost any part of the business world. Let's go there.
You didn't answer the question. Maybe you avoided it on purpose. Is what are our worst businesses?
What are our worst businesses? Well, generally speaking, and this is general, I've made certain mistakes in going into smaller businesses that really never had the potential of becoming big. But I would say overall, probably I would call retailing, Dexter was our worst business, but I have the Furniture Mart obviously is a terrific operation, but we have not made, despite being in numerous retailing, quite a few retailing businesses for quite a while, we have not created major earning power there. Wouldn't you agree on that, Charlie?
Yeah, but luckily it's a small part of the operation.
Yeah.
But you're right. That's been the hardest game for us. And if we were a little smarter, we could have figured that out better.
Well, if we were a little smarter, we could have done a lot of things.
Yeah, right.
Yeah. Of course, Sears is a retailing business to some degree.
Yes.
And we had enormous success there. So maybe we started thinking we were geniuses. We were like the duck on the pond when it was raining, and we thought we were rising in the world because of merit, and it was just because it was raining. Yeah. Okay, we'll go to number 2.
Joel Tillinghast, Boston, Massachusetts. What's the proper way to think about goodwill and return on capital? Berkshire's manufacturing, service, and retail businesses earn pre-tax returns on tangible capital over 20%, which suggests either skilled managers or fantastic businesses. But the return on allocated equity is in the single digits, which looks drab. Accountants treat intangibles similarly because they have different economics. For an indestructible brand like Sears or Coca-Cola, I can see why the intangibles should not be amortized because it's worth more every year. And your comments on Geico policyholders were one way to think about that. But all the tobacco companies have billions of dollars of goodwill, and unit sales of cigarettes decline every year in developed countries. So perhaps they should be amortized. And for Time Warner, AOL, goodwill definitely needed to be amortized.
Yeah, goodwill, you mentioned AOL, Time Warner, something sort. It should be written off, actually. I mean, it wasn't, it was just a mistake in purchase price. The goodwill should not be used in evaluating the fundamental attractiveness of a business. There you should look at return on tangible assets, and even then there's some other adjustments you may want to make. But basically, in evaluating the businesses we own, in terms of what the management are doing and what the underlying economics of the business are, forget about goodwill. In terms of evaluating the job we're doing in allocating capital, you have to include goodwill because we paid for it. So if we buy, Coca-Cola goes back to 1886 and John Pemberton at Jacobs Pharmacy in Atlanta, and there was not a whole lot of goodwill put on the books when he sold that first Coca-Cola. If you were to buy the company now, the whole company, you would be putting a figure, $100 billion or something like that on it. You shouldn't amortize that. And you shouldn't, in judging the economics of the business, look at that. But in terms of judging the economics of the business that purchased it, we'll call it Berkshire, then you have to allow for the goodwill because we are allocating capital and paying a lot for it. I don't think the amortization of goodwill makes any sense. I think write-offs of it, when you find out you've made the wrong purchase and the business doesn't earn commensurate with the tangible assets employed and plus the goodwill, I think write-offs of it make sense. But when looking at businesses as to whether they're good businesses, mediocre businesses, poor businesses, look at the return on net tangible assets. Charlie?
Well, I think that's right. But as the gentleman says, when we buy a business, a whole business, we never get a huge bargain. And of course, we may get down toward 10% pre-tax earnings on what we pay. That isn't so awful as you think when a lot of the money comes from insurance float that costs you nothing. In other words, if you have $60 billion afloat and God gives you $6 billion a year of earnings, it's not all bad.
Well, on Lubrizol, we're paying close to $9 billion for the equity, and it earns. And you should make adjustments for debt, but it's not an important factor there. And current rate of earnings is probably $1 billion pre-tax. And now Lubrizol itself is employing they're employing, call it, $2.5 billion of equity to earn that $1 billion of pre-tax. So it's a very good business in terms of the assets that are employed, but when we end up paying the premium we pay to buy into it, it becomes $1 billion pre-tax on something close to $9 billion. You have to judge us based on close to a $9 billion investment. You have to judge James Hambrick in running the business based on the much lower capital that he has been employed. It can turn out to be a very good business, and we can turn out to have made at least a minor mistake if it isn't as good a business as we think it is now, but still is a very satisfactory business based on the tangible capital employed. Charlie, can you make that clearer?
Well, it's just we are not going to buy, in the climate we're in now, operating businesses that are all decent for low prices. It's just not going to happen.
In the book about Charlie, Damn Right, by Janet Lowe, Charlie talks about his view on teaching finance. He says that he would use the histories of 100 or so companies that did something right or wrong as a basis for teaching the course. Could each of you, and since this concerns Charlie, could each of you, we'll start with Charlie, give us an example or two from either category, right moves or wrong moves?
I predict Charlie's going to talk about Costco. Go ahead, Charlie.
Well, Costco, of course, is a business that became the best in the world in its category. And it did it with an extreme meritocracy and an extreme ethical duty, self-imposed, to take all its cost advantages as fast as it could accumulate them and pass them on to the customers. And of course that created ferocious customer loyalty. And it's been a wonderful business to watch. And of course strange things happen when you do that and do that long enough. Costco has one store in Korea that will do over 400 million in sales this year. These are figures that can't exist in retailing, but of course they do. And so that's an example of somebody having the right managerial system, the right personnel selection system, the right ethics, the right diligence, and et cetera, et cetera. That is quite rare. And if once or twice in a lifetime you're associated with such a business, you're a very lucky person. And the more normal business is a business like, say, General Motors, which became the most successful business of its kind in the world and wiped out its common shareholders, last year? That is a very interesting story, and if I were teaching a business school, I would have value line type figures that took people through the entire history of General Motors, and I would try and relate the changes in the graph and in the data to what happened in the business. And to some extent, they faced a really difficult problem. Heavily unionized business combined with great success and very tough competitors who came up from Asia and elsewhere, and to some extent from Europe. And that is a real problem, which of course, to prevent wealth from killing you, your success turning into a disadvantage, is a big problem in business. And so there are all these wonderful lessons in those graphs. And I don't know why people don't do it. The graphs don't even exist that I would use to teach. I can't imagine anybody being dumb enough not to have the kind of graphs I yearn for. But so far as I know, there's no business in the school in the country that's yearning for these graphs. Partly the reason they don't want it is that if you taught a history of business this way, you'd be trampling on the territories of all the little professors and subdisciplines. You'd be stealing some of their best cases. And the bureaucracies, even academic bureaucracies, people protect their own turf. And of course, a lot of that happened in General Motors. I really think the world, that's the way it should be taught. Harvard Business School once taught it much that way, and they stopped. And I'd like to make a case study as to why they stopped. I think I can successfully guess. It's a course in history of business trampled on the territory of barons of other disciplines, like the baron of marketing, the baron of finance, the baron of whatever. And this IBM is an interesting case. I mean, there's just one after another that are utterly fascinating. And I don't think they're properly taught at all because nobody wants to do the full sweep.
Charlie and I were on a plane recently that was hijacked.
With what?
It was hijacked. I'm telling about our experience on that hijacked plane when the hijackers picked us out as the two dirty capitalists that they really had to execute. But they were a little abashed about it. They didn't really have anything against us. So they said that each of us would be given one request before they shot us. And they turned to Charlie and they said, "What would you like as your request?" Charlie said, "I would like to give once more my speech on the virtues of Costco with illustrations." And the hijacker said, "Well, that sounds pretty reasonable to me." And he turned to me and said, "And what would you like, Mr. Buffett?" And I said, "Shoot me first." Anyway. Okay, number 3.
Sumit Mehra from Kashmir in India. Mr. Buffett, hope you enjoyed your first trip to India.
I sure did.
Here's my question. One of the most important things that drive people are incentives. But if you live in a rich society, it's very hard to get your kids to work hard and reach their full potential because they just don't need to. So if you or Charlie decide to have a kid in the next 5 years,
there'll be a star in the east.
It will take more than a decision.
How would you incentivize him or her to compete against the hungry and highly motivated kids from emerging markets like China, Brazil, Russia, or India?
Yeah, I think certainly that if you are very rich and you bring up your kids to think that they are more important in society or that they have some special privilege simply because they came out of the right womb, that's just a terrible mistake. But Charlie has raised 8 children that I know quite well, most of them, and I don't think any of them have that sense. But if you really are going to raise your kids to think that other people should do all the work for them and that they will be entitled to sit around and fan themselves for the rest of their lives, I mean, you will probably not get a good result. Charlie's been rich most of the time when many of his kids were growing up. Some of his kids were growing up. I've been rich while my kids were certainly when they got into high school and college. But I certainly didn't want to give them the idea that they were special just because their parents were rich. And I don't think you necessarily have to get a bad result or have children that don't have any incentives simply because their parents are rich. The one thing I don't think you want to give them an incentive to do is try and outdo their parents at what their parents happen to be good at. I don't think that makes sense whether you're a professional athlete or a rich person or whatever it may be, a great novelist or you name it. But I really think if you're rich and your kids turn out to have no incentives, I don't think you should point at them. I think you should probably point at yourself. Charlie?
Well, I don't think you can raise children in an affluent family and have them love working 60 hours a week in the hot sun digging fence post holes or something. That's not going to work. So to some extent, you are destroying certain kinds of incentives. And my advice to you is to lose your fight as gracefully as you can.
I'm not sure if you're poor, if you can get your kids to love the idea of working 60 hours a week. They may have to, but
the kids that really get interested in something will work no matter how rich they are. But it's rare to have an Ajit-like intensity of interest. You know, if you were a proctologist, you might not like your day as it went on and on.
I think we better move along. Becky?
This question is from Mike Rifkin. He wants to ask about 5 transactions you made in recent years with very different terms. Goldman, $5 billion at 10% plus warrants. GE, $5 billion at 10% plus warrants. Dow Chemical, $3 billion at 8.5% convertible to common. Wrigley, M&M Mars, $4.4 billion at 11.45. Swiss Re, $2.7 billion at 12%. Now, why the different interest rates, he said, and how about why the warrants in some cases, and why did the rich Mars family need $4.4 billion to do a deal and at 11.45%?
Well, we'll let the Mars family speak for themselves, but in terms of comparing those 5 deals, it was $3 billion with GE, and the Mars deal actually involved a $2.1 million preferred stock, which has some unusual characteristics, so you have to look at it as a package. But the important thing is that every one of those deals was done at a different time, although the Goldman and the GE deals were done in close proximity with each other. And market conditions, you know, you heard Charlie in the movie talk about opportunity costs. Our opportunity costs were different in every single one of those 5 transactions. And incidentally, we could have done I could have done a much better job of allocating our money, you know, in terms of the post panic period. I was early on Goldman and GE compared to the situation 5 months later. But, you know, we not only don't have perfect foresight, sometimes it's pretty bad. But each deal, when I did the Swiss Re deal, I was not thinking about the Dow Chemical deal, which was committed to maybe a year plus earlier. I was thinking about what else I could do with $2.7 billion. And that's the way all the decisions are made. So they are not related. They're not related to each other. They go through a mind that is looking at everything available that day, including the amount of cash we have, the likelihood of being able to do something else next week or next month, what else we can do that day. And past deals we've made don't really make any difference. In fact, one of the errors people make in business, and sometimes it can be a huge error, is that they try and measure every deal against the best deal that they've ever made. So they say, you know, I'd made this wonderful deal for maybe an insurance policy written, it might be a company bought, it might be a stock bought, and they're determined that they're never going to make a deal that isn't that attractive in the future. And so they, in effect, sometimes they take themselves out of the game. The goal is not to make a better deal than you've ever made before. The goal is to make a satisfactory deal. It's the best deal that you can make at the time. And Charlie relates it to marriage, and I'll let him expand on that.
No, those are, of course we're going to make different deals at different times based on different opportunity costs. There's no other rational way to make deals.
Keith McGowan, Norfolk, Massachusetts. Thank you, Mr. Buffett and Mr. Munger. Thank you for being a role model. Your ethics, frugality, sense of humor, honesty, sharing your ideas on investing, sharing your ideas on business, make this world a better place for everyone. Charlie mentioned in a prior answer about continuous learning. Mr. Buffett, you read about 5 newspapers a day. You also read many annual reports and other business-related reports. You have the ability to read much faster than the vast majority of people. Reading is a fantastic thing. What advice would you give to children in high school, college, or adults who want to increase their ability to read faster?
Well, you know, that's an interesting question because I do read, as you described, the 5 papers and lots of 10Ks and 10Qs. Unfortunately, I'm not a fast reader, and I'm not as fast as I used to be on reading. But I don't know how effective various speed reading classes may be, but if they are effective, you know, I would really suggest anybody that can improve their speed. I wish I could read a lot faster than I can. Charlie can read faster than I can, and it's a huge advantage to be able to read fast. And you know, there's that old Woody Allen story about how he took the speed reading course, and he met somebody who was telling how wonderful it was, and the guy said, "Well, give me an example." He said, and Woody Allen said, "Well," he said, "I read War and Peace last night in 20 minutes. It's about Russia." You know, man. That's the problem I have when I try and read fast. I get all through reading the book and I say it's about business. You know, so I really don't know the effectiveness of speed reading type courses, but if you know of any friends or you can learn more about that, and there are effective techniques. Obviously, the thing to do is to learn them very young, because there's really, you know, there's nothing, there's hardly anything more pleasurable, you know, than reading and reading and reading and reading. And Charlie and I do a lot of it. We continue to do a lot of it, but I don't do it as fast as I would like to. Charlie?
Well, I think speed is overestimated. I had a roommate at Caltech who had a very distinguished mind, and I could do problems faster than he could, but he never made a mistake, and I did. So I wouldn't be too discouraged if you have to go a little slower. What the hell difference does it make? I'll pass that peanut brittle for him.
Yeah.
Thank you. Thank you.
You may have noticed we have a 15-pound box out for sale in the other room, but Charlie was looking for a 25-pound box. Becky?
This question comes from Eric Weissman, who asks, are you worried about Congress playing politics with the raising of the debt ceiling? What would this do to Berkshire Hathaway stock and to the overall economy?
You mean if they didn't raise it?
If they didn't raise it.
Yeah.
Right.
Well, it would probably be the most asinine, you know, act that Congress which ever performed. At one time in Indiana, back in the 1890s, I think they passed a bill. I know it was introduced. You can look it up on a search engine. They passed a bill to change the value of pi, the mathematical term pi, to an even 3, because they said it would be easier for the school children to work with. Well, that's the only bill I can think of that would give competition to a refusal to raise the debt ceiling. I mean, it's extraordinary. I mean, it really is extraordinary that with our deficit running, you know, well over $100 billion a month, and all kinds of items that can be changed. I mean, having a debt ceiling to start with is a mistake. I mean, it doesn't. The United States of 2011 has a different debt capacity than the the United States of 1911, and it's going to be a growing country, and we're going to have a growing debt capacity. That doesn't mean I think it's a great idea at all to have debt growing as a percentage of GDP, but to stick debt ceilings on so that these games get played and all the time that gets wasted and everything, and the amount of number of silly statements that you hear, and it just seems such a waste of time for a country that's got a lot of things to do. But in the end, they won't, in my view, there's no chance that they don't increase the debt ceiling. And I would love to see them, I'd love to see them eliminate the idea, because it results in these periodic kind of stalemate operations where everybody uses it for posturing purposes and everything of the sort. But the United States is not going to have a debt crisis of any kind as long as we keep issuing our notes in our own currency. The difference between being able to borrow in your own currency and having to borrow in another currency is night and day. The only thing we have to worry about is the printing press and inflation. And if you're a member of the European Monetary Union, you have to worry about, you can't print money. You can go and get your co-members to try and help you out. But giving up the right to issue debt in your own currency is a huge step, and the United States has not done it. I don't know whether we've ever issued U.S. bonds in any other currency, but we certainly haven't made a habit of it. And the Japanese, incidentally, which have a very high ratio of debt to GDP, also have consistently borrowed in their own currency. And believe me, when it's time to pay somebody back, and you have a choice of paying, and you're forced to pay in somebody else's currency versus paying in your own, it's an entirely different proposition. Matter of fact, Charlie and I, we were trying to buy that bank back in
Chicago.
Yeah, in Chicago in the late 1960s. And this was a time of really tight money, and tight money was different then than tight money is today. I mean, tight money meant no money. And we wanted to buy this bank, and they wanted, the only place we could find some money, I think, was in Kuwait in dinars, wasn't it?
Kuwait, you got dinars.
Yeah, and I thought to myself, and Charlie concurred, who the hell knew what they were going to say the value of the dinar was when we went to pay it back? I mean, it was not something over which we had a lot of control. So we decided not to borrow the money in dinars, even though I kind of wish we'd bought the bank. But, Charlie, have you got anything to say on that?
No. I do think, I remember an era when we had a bipartisan foreign policy and all that, and I liked that era. And that was the Marshall Plan, and a lot of wonderful, constructive things were done. And they were generous things. Now it seems to me that both parties are trying to compete to see who can be the most stupid, and they keep topping one another.
You can tell Charlie is a fellow who's always filed an accurate income tax form. He's not worried. Number 7.
Tanya Leneva, Boston, Massachusetts. When you think about long-term cash flows, do you try to forecast growth, or do you just think about certainty? If you have an indestructible company like Coca-Cola or Burlington Northern, do you try to estimate growth?
Well, we think. Are you finished on that?
Yes,
yeah.
Thank you.
Growth is part of the investment equation, and obviously we love profitable growth. So if we would love to figure out a way to, say, take a See's Candy, to move it geographically into new areas, all kinds of things. I mean, if we could find areas for growth with See's, it would be likely to be very, very profitable. If Coca-Cola which is in 200 countries, I mean, they have pursued that policy successfully now for 125 years. And some products travel way better than others. But when we look at a business and we're looking out in the future, obviously if we see growth in that picture and it's growth produces a high return on incremental capital involved, we love it. But we do not rule out companies where we think there'll be little or no growth if the price is attractive relative to the earning power. There will be some growth over time in something like lubricants, at Lubrizol, but it won't be dramatic growth. And would we love it if it were going to grow 10% a year in units or something of the sort? Sure, but it isn't. That's not going to happen. So it's a factor in every investment decision because we're really looking out to the future as to future earning power, but also future capital requirements. And we think plenty about whether any business we go into is likely to grow profitably. And sometimes we're right and sometimes we're wrong. But we don't rule out companies that have very slow growth or no growth possibilities. Charlie?
Yeah, well, the interesting thing is that in our country, the business schools teach people to make these projections way in the future, and they program these computers to grind these projections out. And then they use them in their business decision making, et cetera, et cetera. I've always regarded those projections as doing more harm than good, and Warren has never prepared one that I know of. And where an investment banker prepares one, we tend to throw them aside without reading them.
We turn them upside down, actually.
What?
We turn them upside down.
Yeah. And I think an enormous false precision gets into things when you program computers to make forward projections for a long period of time. We make rough projections in our head all the time.
Sure.
And we don't do any of those formal projections because the fact that they're there in paper and came out of a computer makes some people think they must be significant. I really think they do more damage than they do good.
When we bought Scott Fetzer, which was back in about 1985, it had been shopped by First Boston to more than 30 parties. They never got around to calling us. So after shopping it to 30 parties, Scott Fetzer finally was working out a deal with an ESOP after something else had fallen through. I forget the exact details. And I sent a letter to Ralph Shea. I'd read about it in the paper. I never met him, never talked to the guy. But I sent him a letter. I figured I'd gamble 21 cents or whatever the first class rate was then. And I said, we'll pay $60 a share if you like the idea. I'll meet you in Chicago Sunday. And if you don't like the idea, tear up the letter. So that took place, and Ralph met me. And we made the deal. And we paid the $60 a share or whatever it was. And Charlie and I went back to sign up the deal. And the fellow from First Boston was there. And he was a little abashed since he had not sent us, contacted us at all when they were looking for something. But naturally, he had a contract that called for a few $1 million of commission, even though he not bothered to ever contact us. And we made the deal by ourselves. So in a moment of exuberance, while he was collecting his few $1 million, he said to Charlie, he said, well, we prepared this book in connection with Scott Fetzer, and since you're paying us a couple $1 million and have gotten nothing so far, he said, maybe you would like to have this book. And Charlie, with his usual tact, said, I'll pay you $2 million if you don't show me the book.
Mr. Buffett, Mr. Munger, it's an honor and a pleasure. My name is Ben Anderson. I'm from Los Angeles. When you're looking at an investment in China, where the business culture is a lot different than it is here in the U.S., and successful business practices are, again, very different than they are here. What are the characteristics you look for when placing an investment in that company, and is that any different than the general principles at Berkshire?
We follow the same principles, but we recognize that we know less about tax laws, about customs, about attitudes toward shareholders anytime we get outside the United States than we know in the United States. Now, to varying degrees, we weigh in that uncertainty. At the time I bought PetroChina stock, which I don't know, it's probably 2003 or thereabouts, it was extraordinarily cheap in relation to any calculation of reserves or refining capacity or cash flow or you name it. And at the same time, Yukos in Russia was similarly very, very cheap. And they were both huge. And I am no geopolitical expert or anything of the sort, but I decided I was more comfortable buying PetroChina than I was buying Yukos. Now, was I as comfortable buying PetroChina as I would have been buying, some domestic company of similar size? No, because I don't know as much. I didn't know then, and I don't know as much now about all the intricacies of Chinese tax law and what the policies might be. But I was fairly impressed, quite impressed, when I read the report of PetroChina. For one thing, they said they were going to pay out 45% of, as I remember, 45% of their earnings and dividends. That's more than any company in the oil company in the United States would tell me. So I regarded that as a plus and an indication of intent that I thought would be fulfilled, and it has been fulfilled. So we do make allowances for our lack of understanding as well as we might in the United States, various key factors. But the basic principles of trying to value the business, trying to find managements in which we have confidence in both their ability and integrity, and then finding an attractive purchase price, those principles apply wherever in the world we would be investing. Charlie?
Well, we make so few investments in China that trying to draw general lessons from us would be hard. It reminds me of the time a professor went west for the summer and he came back to his faculty and he said, "I've learned that Indians always walk single file." And they said, "How did you figure that out?" And he said, "I saw one and he did."
How do we get from there to China?
Well, we only had a couple of things in China that were like the one Indian. You can't draw general lessons from our.
But we're willing to look tomorrow. I mean, obviously, if we had a call on some, that would be a significant size investment because it just doesn't make any sense for us to look at things we can just put a couple $100 million in. But I love the idea of looking at various ideas. I mean, I find it a fascinating game to hear about companies or businesses that are new to me. And the problem now is that the universe has gotten much smaller because of our size. But we welcome a call from a lot of countries. There's some countries that are just too small. They're not going to have businesses that could move the needle at a place like Berkshire, and so those are off the list. But
China has at least one private company that makes over $3 billion a year after taxes. There's some big things out there.
I'll get the name from him later, but I don't want you to hear. Becky?
Hi, my name is Badal Pandi. I'm from Philadelphia, Pennsylvania. Questions about Todd Combs, the young money manager you hired late last year. For Mr. Munger, I understand you introduced him to Berkshire. Could you talk a little bit about that, how that relationship started, and how, as we as shareholders, are we going to be able to assess his progress?
Well, I hate doing this because I may get more letters than I want. But he sent me a letter. That's how it happened. It was like Warren's letter to the guy at Ralph Shea. And at any rate, I had a meal with him, and I called Warren and said, "I think this is the guy you should talk to." We have a very complicated business and very elaborate procedures, as you can tell.
And his results will be known over a 5-year period or something. I mean, you cannot judge an investor by what they do in 6 months or a year.
Todd has the advantage that he's been thinking about financial companies like Berkshire for a great many years. That's useful for us to have around.
And as we put in the annual report, it's more likely than not, but not a sure thing, that over time we have more than one investment manager. There's a lot of money at Berkshire to be managed, and it would not be a bad idea, but we have to find the right people, and the right people just does not mean a given IQ or a given past record. It means a lot of things. And if we end up with 2 or 3, that's a plus. But it's not, we don't mandate that sort of a result.
Good afternoon. My name is Christopher David. I'm an entrepreneur from Arlington, Virginia. My question is about the youth. I work with a lot of high school and college students and recent graduates who are facing a job market with 20% youth unemployment, and at the same time, one of the most favorable entrepreneurial environments. It's easier than ever to start a business or get involved with a startup. So, considering that these kids are politically savvy, they like studying economics, they're brilliant, and they're willing to learn, what advice can you give them from an investment perspective that could help them chart their own course as opposed to get a 9-to-5 job?
Well, the main thing you could do, and people do it different ways. I used to do it by doing a lot of reading. I was practically lived at the Omaha Public Library for 3 or 4 years, and when I was 9 or 10 or 11. I mean, anything you do to improve your own skills, you never know where it's going to pay off later on. I have one diploma hanging in my office, and I got a couple of others, but the one diploma I have hanging up there is one I got from a Dale Carnegie course, which cost me $100 back in 1951. And it's incalculable how much value I got from that $100. There's nothing like working to improve your own skills, and I would say communication skills are the first area I would work on to enhance your value throughout life, no matter what you do. I mean, if I had stayed in the same position I was in terms of communicating back in 1950 or 51, my life would have turned out differently. I mean, I started selling securities. If you can't talk to people, you've got a real problem selling securities. So I think if you get lucky, you find your passion early on. But you want to work at something you're passionate about, and then you want to work to improve your skills in that. And I think if you do both of those things, I think you're likely to do very well. Charlie?
Yeah, I think economics is a really tough subject, and I think it's easy to teach the basic microeconomics and certain of the basic ideas, but the minute it gets into the full range of complexity, you have the difficulty that the experts disagree. So I don't think I would hurry if I were trying to learn something into the parts of the fields where none of the experts can agree among themselves. I would master the easy stuff first.
Yeah, I don't think. Yeah, I would not advise taking lots of courses in economics to somebody going to school. Just trying to think back. It's been a long time since I took my economics courses at Wharton, but I don't regard them as the ones that push me forward in any significant way. Carol?
Hi, I'm Glenn Tung from New York. First off, thank you for a terrific day. My question deals with acquisitions. Pre-Lubrizol, we estimated Berkshire's year-end 2011 cash balance could approach $60 billion. I believe you commented recently on an elephant that you thought was too big. What is your acquisition appetite? What size is too big? Has the phone been ringing lately? And what, if anything, can we as shareholders do to help?
I got through college answering fewer questions than that, but but anything you can do to help, I appreciate, Glenn. It's hard to name a precise figure. This one, was way too big, except unless we used a lot of stock, which, like I say, we wouldn't do. Our appetite is always there. We are not going to borrow a lot of money. We're not going to issue shares, except perhaps in some minor amount to make a deal that couldn't get made otherwise. And we obviously will never sell a business to buy some other business. So, our cash balances will tend to build month to month unless we do something, and we can and will sell some portfolio securities. But doing Lubrizol requires close to $9 billion of cash, and obviously we could do another one of that size. In fact, we're looking at a couple, but they're no more than a gleam in the eye. But they would take sums roughly similar to Lubrizol, and we would be comfortable doing those, and they would add significantly to Berkshire's earning power. So they're worth doing, but we can't do a really big elephant now, and we won't stretch. We've never really taken any risks because we don't need to, and we will not trade something that we have and need for something that we don't have and don't need, even if we kind of like to have it. Charlie?
Well, I certainly agree with all that. We are very reluctant to issue shares, and in that we're different from most places. I have a friend that sold out to a socialist country, and they issued shares in a controlled corporation, and the socialist executive said, "Isn't this wonderful? We're getting this business for nothing."
Yeah, some people really have that. And of course, there are some companies, and we talked about the wave that took place in the late 60s, but periodically, and certainly it happened during the internet period, where companies just couldn't issue shares fast enough because they were trading confetti for real assets. And that is a business model that has been applied successfully for some periods of time by certain companies in the past. It usually ends in some kind of a fiasco, but, well, I shouldn't say it usually does, but it runs out of gas at some point. But essentially we've never been in that game. We hate issuing shares, and the idea of selling when we issue shares, we're divesting ourselves of a portion of every wonderful business we have, from Geico to ISCAR to you name it. And we don't like doing that. We like owning those businesses. We like to own more of them. We have a deal, for example, on Marmon, where we bought some more of it this year, and we will buy the rest of it in a few more years, and we feel good about that. We pay a fair price for it, but we get a business we know, a management we like, and that's really what we'd like to continue doing at Berkshire. In fact, we will continue doing it. Andrew?